Material we have today is an investment thesis, and it's making a pretty bold claim. Forget NVDA and instead look at a small-cap AI company, RZLV AI, for 2026.
Yeah, and it sets the stage really well. I mean, it does a great job pivoting the investor's view away from that, mature infrastructure layer, the NVIDIAs of the world, to the application layer.
Right, to where the hypergrowth could be. It highlights that risk-reward for a small cap like RZLV, which is, under $1 billion valuation?
Exactly. And that macro rotation argument is, I think, the core strength here. It's not just a stock pick. It's a thesis on where the value is going to accrue next.
From the road builders to the race cars using the roads.
That's the one. But to really convince a high-risk investor to actually forget NVDA and stomach that kind of volatility, the material must deepen the proprietary technical moat to justify the extreme risk.
Okay, that's a great topic sentence. I see what you're getting at. If you're telling someone to pass on, one of the biggest success stories on the market, your alternative has to be almost bulletproof.
It has to be. And the weakness right now, I think, is that the argument focuses a little too much on RZLV being cheaper or just growing faster. That 426% revenue growth is eye-popping, sure.
But it's an effect, not a cause.
Exactly. It's a consequence. The material doesn't quite establish why their technology, their LLM, called brainpower, is so unique that a bigger competitor can't just come in and replicate it. It mentions the moat, but it doesn't really build it out for the reader.
And that's the absolute critical fear in the AI application space, isn't it? That you just become a commodity reseller, renting APIs from the big players. And if that's the case, that growth just isn't defensible.
Not in the long term. No. So, the suggestion for improvement here is to really lean into the proprietary nature of brainpower. You need to explicitly explain why owning their own model gives them a protected, higher margin business.
You have to separate them from the pack.
You have to. So you need to shift the emphasis from just look how fast they're growing to look at the defensible IP that is fueling that growth.
So how do you make that tangible for an investor? How do you show that economic advantage without getting lost in the technical weeds?
Well, with a couple of concrete examples. First, you explicitly connect their data independence, the fact that they own and train their own model on commerce data, directly to their margin forecasts.
Ah, okay.
Owning the model means you control your costs. You're not subject to, the crazy volatile pricing of external APIs that can crush your margins overnight.
Right, that completely changes the risk profile of the investment. It's not just that they're growing fast, it's that they're built to be profitable.
Precisely. And second, that analogy you used, NVIDIA builds the roads, RZLV AI builds the race cars. It's great, so use it. But take it a step further. Make the case that brainpower is the specialized engine in that race car.
An engine you can't just swap out?
Exactly. It's custom built for the commerce racetrack. You can't just drop in a generic engine and get the same performance. That's what makes it defensible.
And that makes the whole forget NVDA argument so much more powerful. It's not about stability versus growth anymore. It's about commodity versus proprietary edge.
It all connects. Okay, so let's shift gears a bit to the financials. The piece is rightly transparent about the bear case. A $3 stock, the volatility, and of course the big cash burn, a net loss of $57 million.
You have to include that, but I think your point is that the way it's presented could be refined?
Yes. For this kind of sophisticated investor, the negative financials must be woven into the bull case narrative to proactively neutralize skepticism about liquidity and capital efficiency.
Right, it's about framing.
It's all about framing. The weakness right now is that this $57 million loss is sitting in its own section called the bad. It treats it like a standalone flaw, and it just sort of hangs there without any immediate rebuttal.
Yeah, an investor sees that 400% growth, gets excited, then they hit a wall that says negative $57 million, and they immediately pump the brakes.
They walk away. It's a psychological pitfall. They see that burn and they think it's just, operational waste or bad management.
So we have to get ahead of that skepticism.
Yes. The suggestion is to reframe that loss. It's not a risk in the traditional sense. It's the strategic cost of achieving that hypergrowth and building the proprietary moat we just talked about.
So this is the investment required to secure their future dominance.
It is. This is them spending now on the IP and the big contracts that are going to generate massive margins tomorrow. It's not just keeping the lights on. So for a concrete example, first, just physically move that discussion.
Okay.
Take the $57 million net loss and put it immediately after the 426% revenue growth. You want the reader to connect those two numbers in their mind.
Frame it as the cost of scaling.
The cost of scaling and acquiring the IP needed to hit that, $10 to $15 analyst target. The high cost becomes a prerequisite for the high upside.
I like that. The analyst target actually helps justify the burn.
It does. And second, you have to contrast RZLV's spending against competitors. You explicitly state that they are investing in their own proprietary tech, while others might be just burning cash on, say, expensive marketing or renting someone else's infrastructure.
That's a crucial distinction. It shows the burn is strategic IP building, not just waste.
It shows they're making a calculated investment. And see, that reinforces our very first point about the moat. The strategic burn is what's funding the moat's defense.
It all links up. Okay, let's move to the last piece, the product deep dive. I thought it was pretty clear in laying out the problem, that mobile shopping is full of friction, and the solution with their Brain and Shop platform.
The clarity is there, yes, but the conviction feels a little soft, especially given those huge financial results. The thesis establishes the potential of the product, but with that kind of revenue explosion already happening, the deep dive needs concrete data points that anchor the product's effectiveness to real-world commercial success.
Ah, okay. The what is clear, but the how effective is missing.
Exactly. You've got this incredible, almost unbelievable 426% growth number, but then the product section itself is mostly conceptual. It describes what the platform does, turning any media into a checkout, but it doesn't give us any hard evidence of its performance.
So the reader's kind of left to trust that the product must work because the revenue is so high, instead of understanding that the revenue is high because the product works so well.
You've got it. We need to turn that conceptual solution into a quantified success story. So the suggestion is to strengthen that what does Resolve actually do section by connecting the product's core function, that instant checkout, to specific high-impact results that explain the growth.
We need to show the engine in action. So what does that look like? What kind of data points are we talking about?
Okay, for a concrete example, instead of just saying major collaborations with tech giants, offer a hypothetical but realistic metric. Something that tackles the core problem RZLV solves.
Which is friction.
Right, friction. So you could add something like, RZLV's one-click platform delivers an estimated X% higher conversion rate on mobile ads compared to traditional models, where cart abandonment is often over 70%.
That immediately quantifies the value. It gives context to the revenue growth. It's not just a random number. It's a result of solving a massive, multi-billion-dollar problem.
Yes. And secondly, the thesis mentions the new hires from Apple and Google, which is great social proof. But don't just drop their names. Detail how their expertise is being used to scale the Shop platform and to handle those big enterprise partners.
So it's not just a good hire, it's a strategic move to pour fuel on the fire.
It shows the reader that the human capital is now in place to turn that initial surge into sustained, multi-year growth.
That's excellent. This has been a really focused critique, and it feels like it takes an already strong thesis and just really tightens the screws.
Absolutely. I mean, the core idea, forget NVIDIA. Look at this asymmetric opportunity. It's powerful. We've just identified, three main areas to really maximize that investor confidence.
Okay, so let's recap. First, fortify that technical moat around brainpower. Connect the company's data independence directly to their ability to defend their margins.
Right. Move the argument from just fast growth to defensible, profitable growth. Second, strategically integrate the cash burn. Reframe that $57 million loss as the necessary cost of scaling an IP acquisition.
Don't let it sit there as an isolated negative. And third, enhance the product description with quantified results. Use metrics like conversion uplift to prove why the product is driving that 426% revenue explosion.
Exactly. These adjustments are all about getting ahead of an investor's skepticism on the moat, on liquidity, and on product market fit. We're really eager to see how these refinements shape the final piece.
We encourage the listener to take these suggestions, refine the material, and please submit the revised investment thesis back to us. We look forward to seeing the next draft.